So we've been through and looked at all the price action patterns now, and we've also seen moving averages, we've seen support, resistance, trend lines. It's time that we actually put it all together and identify high probability trading opportunities on the charts. Now, we're going to start off looking at the Euro US dollar, and we're going to look at it over the last year, and we're going to identify the trading opportunities that have developed over that period of time. Now, we're also going to focus on primarily trend-based trading opportunities only. So to start, we can see that looking throughout this period here, we're just in a very sideways, choppy mess. So with regard to trend-based trading, it's very difficult to even find any potential entry through there, purely because it is just so sideways. So we can see that when price breaks outside of this box, I'll just draw the box on now so we can see it. When price breaks outside of this range and breaks through these lows, we then have the potential to find trading opportunities. Now, if we look and draw on this horizontal level through here, we can see that our first potential opportunity would have been the inside pin bar here, which was after the breakout of the level. However, it was just straight through the level and pulled back. We can see that perhaps once price did break through the level and give us the inside pin bar, it gave us a nice strong bearish indication at that point. The reasons why we were looking at that, first of all, is because we have the bar here, or the candle here, that's closed outside of this trading range. That tells us that price is going to break out the range. We've also got the 20 and 50 moving averages widening, and we can see that a downward trend is likely to commence at that point in time. But more than that, we also have a price action signal of a bearish pin bar, which also happens to be an inside bearish pin bar. I'll just mark that on the chart now with a downward arrow. But this would have been a potential trade entry based off the breakthrough, the pullback, and the resistance here that was originally support. So a potential trade entry at that point in time, and if we look at that, we can see that price has moved aggressively to the downside. Now, let's actually look at the specific entries, stop loss, and perhaps targets on that. We can see that on the trading question, we'd be placing a stop loss behind the pin bar itself, and we have an entry point underneath it. Now I'll just make sure that the entry is in blue so it's more visible. But we can see here we've got price action, we've got support becoming resistance, and we've got moving averages helping to confirm this potential trading opportunity. Now we can see that by looking at this, price obviously moved a long way down. And let me be very clear, it's highly unlikely that you manage to run this the whole way down. However, as we look at it, let's look for price action signals as potential exits. Well, as we see here, we have a bearish pin bar, a doji candle, bearish continuation, and a couple of dojis. So over that period there, this market's just simply moving down and starting to stall at that period, giving indecision and again giving indecision. It's not enough to turn around and exit, but it's certainly telling us that there's something else happening there. There could be a pullback about to occur. The real signal here is when we have this bullish engulfing candle, bullish engulfing bar through here, which breaks the downside and then the upside of this previous candle, and then actually closes above the high. This one here tells us, you know what, let's move our stop loss down now, because of the fact this could be the phase 2. So what we'd do is we'd actually move our stop loss down at that point, just above the high of the bar, and we can see sure enough we'd actually get stopped out there. But looking at it, we can see we would have had a winning trade over that period. So we can happily now just look at the price action in more detail. We can see, first of all, the entry signal, price still moving down, the dojis, followed by the engulfing candle here, which then gave us the stop loss movement. Now the risk on that trade was around 60 pips, with the return being around 115 pips. So it's very nearly a 2-to-1 trade. In fact, we'll just put down a 1.9 reward to risk. 1.9 to 1. Because we risked 60 pips and made back almost 120 pips, which obviously indicates it was almost a 2-to-1 trade. And that's very nice. Let's keep going through and see what other trading opportunities present themselves. As we go through there, we can see after this bullish engulfing candle, we have another bullish candle followed by a bearish candle. It's not engulfing. It's not anything particularly special. Unfortunately, there's no real entry into that particular signal there. Now, we keep moving down, keep moving down, keep moving down. We're starting to get these bearish pin bars. And we can see bearish pin bar followed by bearish pin bar. And it also happens to be a ringed high formation. And that means what we do is we place our entry point underneath the low of this bar, or this candle. We put our stop loss just above it, and we can see sure enough we get triggered into the trade, and it moves to the downside. And if we look through again now, we can see we've had in our favour, just in our favour, and it's still a bearish pin bar at that point in time. It's not until we progress from the bearish pin bar onto this bullish engulfing bar that we get our exit signal, which would cause us to move our stop loss down to here as our exit. Now that means that we end up risking 110 pips on the trade to make back about 55. So we actually only in this case made half back what we risked. So we risked 1%, we made a 0.5 return, so it was a 0.5 to 1 trade. Now it wasn't just the price action here, it was also this support level becoming resistance. We can see that these lows very closely matching these highs, but more interestingly than that, if we shrink it back a little bit further, we can see, if I just draw a line for us now, how these lows over here acted from support, becoming resistance, and that actually gave us the trading opportunity. I'll just highlight that on the chart for us now. So that's 2 trades through there and 2 winners, and they are 2 trades we would very likely have taken in that downward trend. Now as we progress through from there, we've got another trading opportunity here. And the next trading opportunity is the next test of this horizontal level, and it also happens to be test of a moving average and another bearish pin bar, which is here. It's a test of a horizontal level, it's a bearish pin bar, and it's bouncing off a moving average. Several things in its favour. It's very likely that we take this trade. We'd have our entry point again underneath the low through there, with a stop loss above the high. Now, as we look at that and look at the bar formation, we see that this bearish pin bar here actually then becomes, with the next bar, we get ourselves a bullish pin bar. Bearish pin bar, bullish pin bar. Which means we could have then moved our stop loss down to here to try and reduce the damage from the trade. As it happens, this was then worked out as a losing trade, and we would have actually lost 1% on this trade. This was an example where the Spanish banks were getting bailed out, and one of the biggest gaps of the year over the weekend occurred from the closing here to the opening up here, which was a particularly large gap of 120 pips. It's very rare that you see anything beyond 20. So 120 was a huge gap because Spanish banks were getting bailed out. And as a result, rather than just simply losing the 45 pips, unfortunately we lost the whole 90 in that case, just because of the fact that the market gapped over the weekend. So we can put down here, this was a losing trade, which was a -1. So throughout that period so far, using moving averages, horizontal levels, and also cyclicity, we've got lower highs and lower lows all the way through this chart, and we've got most of the trading opportunities through there. 2 winners and 1 loser, but overall 1.9 plus the 0.5 means we were 2.4% up. We lost 1, we're still 1.4% up. Now from there we've got the cyclicity giving us higher lows and higher highs, whereas the moving averages are telling us it's still going down. So it's very sensible through here to actually do nothing. Stay out of the way and wait for another trading opportunity. And we then see from the higher highs and higher lows and higher highs, we then get ourselves a lower low across here. And by the looks of things through here, a lower high as well. Now, it's really quite interesting here because we have a lower high, lower low. We're now looking for entries into the marketplace. We have a very strong bullish candle, followed by a very strong bearish candle, which could be a potential entry through there, because we've got very strong bullish followed by an inside bearish candle. We've actually seen that shift from buyers to sellers. It's not really a train track pattern, it's more of an inside bar pattern there, or an inside candle pattern. And as a result, we then have ourselves a sell signal underneath there. And the reason for that is because we've got the lower low and the lower high. The cyclicity is in our favour, and if we look at it, we also have resistance level, support becomes resistance, gets retested as resistance. So we have a horizontal level, we have ourselves a price action signal, we have a reason to enter here, and we also have the cyclicity on side again. Now that means we'd have ourselves an entry signal underneath this seller candle, this bearish candle, and we'd have ourselves a stop loss just above through there. Now it's much more likely that I'd put the stop loss above this bullish candle just to keep it safe really, behind the swing high. It means that our risk on the trade is around 130 pips, and that's something that I'm quite happy with on a daily chart. We can see that the next bar comes along. It's very much a sort of a small candle. It's triggered our order, but it's not really done a huge amount other than that. We're slightly down on the trade at that point in time. After that, we have the price action still moving to the downside, still moving to the downside, still moving to the downside. There's been no exit signal so far, so we keep hold of this position. What's interesting here is we actually have ourselves a reversal bar formation. We've got the sellers through here becoming buyers, perhaps something to be aware of. It's not necessarily going to act as an exit signal in its own, because apart from that reversal bar formation, there's nothing else there to really tell us to do anything. We could argue, however, price has got to the support level. You'd be thinking at this point in time, maybe it's, perhaps tighten the stop loss slightly from where it is up there, so maybe bringing it down a little bit tighter. As it happens, price does actually go down a little bit further before it then starts to stall. So we can see through here that we had ourselves a reversal bar formation, which actually gave us an exit signal through there. And while we were risking 130 pips, we made back around 240 pips. So we made back just over 1.5% from that trade, risking 130, making back 240, about 1.7 to 1, 1.75 reward to risk. As another winning trade. So we're happy over that period of time. Of course, perhaps we can see we could have held it a little bit longer. The price action didn't really give us the exit signal until this bullish pin bar or this engulfing candle here. So perhaps we could have held this trade a little bit longer. If anything, we were happy to lock in the profit that we had. But the reversal bar formation, while reversal bar formations can be good signals to get into the marketplace, they're not always great exit signals. However, we've shown it here as an exit signal, and it's something that we'll stand by. This is interesting now. We're happy that the cyclicity is lower highs and lower lows in our favour, because we're looking to get short. And we can see through here that the moving averages are in our favour as well. And we've now got buyer or bullish candle, bullish candle, bullish candle becoming a bearish candle. i.e. buyer bar, buyer bar, buyer bar, seller bar, or bullish, 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 bearish. We've seen a shift here from buyers to sellers. But the interesting part is we've got 1, 2, 3, 4, 5 bullish pin bars. So we're kind of not sure how to take this. We've got reasons to exit the previous short and also reasons to look to get into the market to the downside. We've now got ourselves a doji candle here. We can see we've definitely got ourselves the shift from buyers into sellers. And if we break this price action down now bar by bar from bullish pin, bullish pin, bullish pin, bullish pin, bullish pin, and doji, it always tells us that there's been buyers trying to get in, but we don't want to buy in a falling market. If anything, this is a falling market, we want to sell. And we're not going to enter off a doji bar itself. It's not a strong enough price action signal to give us a decent move. So at this point, still we're doing nothing, waiting to see what happens next. As it happens, price moves to the downside for a few bars. But look, straight away now, we've actually got ourselves a bit of a doji there again, indecision. We've got train tracks now. Not really a huge move to the downside off of that doji. Okay, something to pay attention to now is that price has pulled back to the previous high. We're still looking to sell through here because of the fact that we've got ourselves the 20 underneath the 50 moving average. However, let's pull back to the same level, but we've actually got ourselves a higher high. You can see these highs here. The current high that's now potentially forming is higher than this high here. In fact, it's definitely higher. We can see here, just pull back, we've got ourselves a higher high. At this point in time, we'll do nothing until we see what's likely to happen next. Remember, we've got the moving averages saying sell, but the cyclicity is broken down, so we're going to do nothing at this point in time. We've definitely got ourselves a resistance, obviously acting as resistance again through here, but through this downward trend, we've got a higher high. It's not really the strongest signal for us to take. So a couple of small little bars through there, small little candles. A huge great pin bar that forms, followed by a great bullish bar. So it's kind of choppy through here. We've got bearish pin, small doji / nothing bar, not a lot happening there. We then have an engulfing bearish candle, another engulfing bearish pin bar as well, followed by an inside bullish candle. Kind of like it's trying to go down, up again. It's choppy through here. So it was sensible for us not to get into the market on this bearish pin example. And look, we now seem to be forming a higher high, and we've actually developed a higher low. So we've got higher highs through here and higher lows. We don't want to be selling in this marketplace. Even though the 20 moving average is underneath the 50, we've got higher highs and higher lows. And I would always pay more attention to the cyclicity than to the moving averages, because the cyclicity is actually showing us on the price action what's happening. The moving averages are lagging and purely there to help us out, nothing extra. Our primary point of focus should be the cyclicity and the price action. You can see we're quite sideways through here now. Nothing particularly for us to do at this point. We can almost see the price action coiling here. We can see the higher highs and the higher lows. In fact, I would have been interested in buying at this point here, were it not for the 20 and the 50 moving average being the other way around. Similarly, I'd be interested actually in buying here if it weren't for the moving averages. Looks like I've been right. You'll often find that happens. And we can see through here now, this is interesting. We've now got ourselves into a position where we've got the 20 moving average as near as damn it about to cross through the 50 moving average. We've got any kind of support levels there? Let's have a look. Let's break this down and have a look. So we've got an engulfing bullish candle. Now we can see that price is actually reacting off this support, becomes support. This resistance didn't quite make it there, and again, it's actually quite a big zone here that we've got of support, support, resistance, support. This is something I'd be interested in buying around here and finding a way into the marketplace. Now, we can see looking at that, we get an inside bar that follows it. There's not really any signal here to get in, or if we had tried to enter in up here, we wouldn't have been triggered. So we now have the 20 moving average above the 50. We're looking for reasons to enter the marketplace to the upside, as we've been discussing from back down here. And here we have it. We've got ourselves a bullish pin. And the interesting part here as well is that it's actually bouncing off of a support level. Support becomes support becomes support. This is a really strong buy signal here because we've got ourselves a nice bullish pin bar, and we've obviously got cyclicity on our side with the phase ones moving to the upside. We can see the markets in upward trend, and we've got the moving averages in our direction, plus a horizontal level, plus price action. So a nice strong signal through here. This would be a good entry point into the market to the upside. So our entry point will be above the high, plus a couple of pips, with our stop loss being underneath the low there. Just going to move this level very slightly just to make it a bit easier on the eyes. We can see our stop loss there as well for our order. Now we wouldn't trade this to a target necessarily, we'll just see what price action signals we get as we progress. We've been triggered into the trade. It's kind of a nothing candle, nothing bar really, not a lot going on there. Big move to the upside. Now big move to the upside here, which has put us in to profit of around about 180 pips. We're risking 130, and at the peak it was worth 190. It's currently up about 1 to 1, so it's going okay. Now the interesting part here is we have ourselves these this reversal bar formation, buyer, 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 seller, which could be a potential exit point. However, bearing in mind what happened last time, the trade could have gone a little bit further. So if you're an aggressive mover of your stop loss, then this would be the first point here to move the stop. However, it's much more likely that if you're willing to let your trade run, you would instead move your stop loss to the break-even level, or perhaps underneath this big bullish buyer candle. As it happens, it didn't really matter either way. The price turned around and went straight back up again, which is good for us. And again, it's moving to the upside, so at this point here, price is strongly moving in our favour. We could quite happily make sure that our stop loss is underneath this inside reversal bar or reversal candle. Price is still moving in our favour, very strongly at this point. Still strongly. And actually now we've got ourselves another reversal formation here, but also a bearish pin. We can see the tight little pin there. It's a doji as well. It's kind of we can see price has moved a long way away from its entry point. We're up around 490 pips or so, and the moving averages are exceptionally moving to the upside, but also the price is a long way away from the moving averages. So at that point in time there, I would be looking to move my stop loss underneath here because several reasons. First of all, I feel that the price is quite overextended away from the averages. That's one. Part two is that it's actually moved a very strong way in our favour. From risking around about 125, 130 pips, we can lock in around 450. So straight away there, from risking 125, now being up 450, we're already looking at 3.5%, touching on 4% of profit. So it's a very good position to be in. 3.5%, 3.7% up there. I'd like to just lock in that profit that we've already made. And the final part is buyer, 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 seller, and it's an inside candle, and it's not just that reversal. We can see prices failed here and tried again and failed. So an inside candle, inside bar, or an inside pin bar, depending on how you see it there, it's certainly worthwhile moving the stop up at that point in time. And we'd be stopped out there. And that one was actually the best winning trade we've seen so far. That one resulted in around about a 3.7% gain, a 3.7 to 1 reward to risk. which is a really nice trade to have banked. Now this could go a little bit further now, but when you're 3.7% up, you're kind of saying to yourselves, do you know what? Is it worthwhile, being a bit more aggressive with a stop loss now? We've let the trade run. It is running. We've locked into really good profit now. Maybe it's time to take that profit. Okay, so let's see what happens next. Let's look for the next entry point. Okay, and this seems to be where it's at. We can see that we've got the previous top of this bar here reacting with the lows through here. A little bit, you could almost argue, of resistance there becoming support. Not particularly strong, but still something to be aware of. The part that attracts me to this is the fact that it's pulled back down to that 20 moving average and giving us a bullish engulfing candle or a bullish engulfing bar. That would make me be interested in buying here and placing an order above the high of the candle. So I'd be looking to place an entry point around here with a stop loss underneath the lows there. It looks highly likely that the price could move to the upside because we're in this upward trend. We've just had a nice winning trade here, so we're happy with how we're set at right now. The trade has triggered, the order has triggered, and it is running against us at that point in time. And it appears it actually stopped us out. Price has come along there and stopped us out. So even with having a few confirmations there, unfortunately it's not been a winning trade. That's been a -1. So we'll just make a note of that as being a -1. We'll do that just over here. That was a loser. But bearing in mind that so far we've had ourselves 1, 2, 3, 4, 5, 6 trades. 2 of them have been losers and 4 of them have been winners. And if we look at the reward to risk on the winners, we've had 1.9 times our risk, half times our risk, which is not a great one. 1.75 times our risk, 3.7 times our risk. So we've got positive reward to risk through there, bigger winners than losers, which is what's been keeping us profitable, plus the success rate. So now that we've lost that one, we'll look and see what other potential signals arise. And we're actually staring straight at it now. We've got ourselves this higher low, higher low. So we can see through the price is actually bouncing off this support level. I'll just move this line up so it's clearer. We can see prices bouncing off that support level. We've actually got ourselves a double touch of this level here, and we've got ourselves a reversal bar formation from seller candles into a buyer candle, so bearish to bullish, and we actually have an engulfing bullish candle there as well, which gives us a signal that price is likely to move up. We've got a level, we've got price action, several price action signals, and we've got the moving averages, obviously price is reacting against. The only thing that's perhaps against us here is the fact that we could be seeing price form a wedge. Now what that means is that we've got a lower high on price action with a higher low. So it's almost as if we're actually forming a wedge shape here. It could only perhaps go up to around that kind of a level. It might not be a particularly strong move to the upside. Having said that, the next part then is down to you. You may choose to take that trade. It's not perhaps as high probability as the one back down here, because we've got that lower high, but it's perhaps something you can consider doing at a smaller amount of risk. Now, for example purposes, we're going to look at taking this at 0.5% risk, because we've got the horizontal, we've got the moving averages, and we've got the price action. The only thing, unfortunately, is cyclicity's broken down very slightly, but if we're right and price does break this high, it's likely that it could keep moving to the upside. So we'll go through and we'll simulate this now as if we're taking it at 0.5% risk rather than the normal 1%. Just catch back up again. So we're in the trade. Price is moving in our favour. If we look at that from the very first bar we got triggered into, we then actually straight away got ourselves this bearish pin bar. So it may have been that we chose to straight away cut our losses and get out there, bearing in mind that we would have had our entry point here with our stop loss underneath it. So we're risking around about 125 pips or so, and we can see from the engulfing candle there to then get the bearish pin, it might be something to say, do you know what, maybe it's time to get out this trade. However, realistically, we've seen it's gone a little bit. We would be expecting price to get to at least this upper level here of this trend line, or counter trend line. We'd at least be expecting price to get to there before it posts a reversal signal. So it's unlikely that we would move our stop loss straight away. Remember, it's important that we let our trades breathe rather than just try and stifle them straight away. So on that particular one there, we're happy that we're in the trade. Price is moving to the upside, and it's actually around here that we get a potential exit signal. We've got ourselves the bullish pin bar, bullish candle, inside reversal candle. Now, the interesting thing here is it's not just a reversal bar formation. We have two buyers becoming sellers, so it's a weak reversal bar formation. But we also have it as an inside candle, and it's also a train track formation, whereby price has gone straight up and straight down aggressively, and we can see how the sizes of these candles are very similar, and the bodies are very similar as well. That kind of warns me now that perhaps the price isn't going to move as aggressively as we'd hoped, and it also perhaps coincides with the fact that people were experiencing a similar kind of thing, not expecting it to go that far. So I'd move the stop loss underneath here now and see what happens next. As it turns out, it would have been the right call. We'd have risked 125 and made around 80 pips there. So we're looking at about a 0.7 reward to risk. So not a great trade. It was a 0.7 to 1, but bearing in mind that we're only going to be risking 0.5% on that, so it was a 0.35% gain. Because we're only risking 0.5% rather than risking the full 1%, because of the fact that we weren't entirely convinced by the cyclicity. This is much better now. We've got these higher lows and higher highs, and we have ourselves this bullish pin bar off of the moving averages in the upward trend. Classic example of the bullish pin bar in play. We've got our entry and our stop loss, with the entry being in the blue, stop loss being in the red. This is a trade that we take now. We've been triggered into the trade, and we've actually been stopped out there. So that will actually act as a -1, which we can just log there. And we have ourselves price still moving to the downside, but look now, we've got a better quality signal because we've got the reversal bar formation, and we've got ourselves the pin bar. The cyclicity is still in our favour, so we're happy to enter above the high of the pin bar with our stop loss underneath. What's interesting through here is that we've had an inside bearish candle, followed then by a bullish candle. So where our pin bar has not been triggered, we've not been triggered into the trade, maybe we choose to take the trade off of the train track candle instead by placing our entry and stop loss like so. We've been triggered into the trade. We've actually been stopped out there, so that's 2 losers on the trot. Now, if we look at that, we can see that we're not going to be happy with that, taking 2 losers, but it's something that we were prepared to do, given the fact that we were expecting the price to continue to move to the upside. We can also see, looking at this, that we've got quite a sideways market at this point in time, and the moving averages are squeezing together. The interesting part there, of course, is that now we've got ourselves this marketplace that's sideways, we need to trade it in a slightly different manner. And we need to trade that in a way where we trade from support and resistance levels at the top and the bottom of the range. Or we choose quite simply to wait until it starts trending again, which is perhaps a safer option. We can see the market's moving to the downside through here now. And as we look at it, the market here is still moving down. We can see there's lower highs and lower lows. And the 20 moving average is about to cross through the 50 moving average. You see right now it's actually quite a difficult marketplace to read. But price seems again to be moving to the upside. This is quite interesting at this point. We've got the 20 above the 50, and the 20 moving average is actually pointing up. The 50 moving average is pointing up. We've got ourselves a bullish pin bar here. We've got these higher swing lows and higher swing highs through here. This would be an entry point into the marketplace that we would like to take. Just pop the entry there with our stop loss underneath. Because we've got the cyclicity on our side, we've also got ourselves the moving averages in favour and the price action. We'll just clear this horizontal line out of the way. We've been triggered into the trade. It's moving to the upside. And the interesting part here is we're in the trade, we're making some money, and we've got ourselves a bearish pin here. And it also happens to be a reversal bar formation. Moving the stop loss here would actually make quite a lot of sense. And we can see through there that actually moving the stop loss was the right call because we would have been stopped out otherwise. As a result, we were risking around 70-75 pips. We returned about 110, so around a 1.5 to 1 reward to risk there. So 1.5% gain, and we can see quite happily another winning trade. Notice it is these positive reward to risk outcomes that are helping us to make the money. Unfortunately, through this period here, we suffered a few losers. When the market goes sideways like that, unfortunately that's going to happen. Okay, next trading opportunity. We're now sitting at this support level. We've also got ourselves this quite convincing upward trend, higher highs, higher lows, and we've got ourselves a bullish pin bar. We're interested at this point in buying above the high with a stop loss underneath the low. We can see it's holding that level, and we're happy that the market's in upward trend at this point. We haven't been triggered. We've actually now got a reversal bar formation that's in play, so we can actually get a slightly better entry into the marketplace, which is even nicer. The good thing here is we've actually got two price action signals. We've got the bullish pin bar, and we've also got ourselves this bullish candle here, which completes the reversal bar formation. So we've got our entry point marked, we've got ourselves our stop loss there marked as well. Our stop loss would stay underneath this swing low just to keep it safe. We've been triggered into the trade. The market is moving in our favour quite strongly at this point. And we can see at this point here, we develop into this doji candle, which is actually a reversal bar formation. And the interesting part here is as well, it's actually at this level of resistance where it's formed. What we do here is we'd actually move our stop loss up to lock in the profits we've made. Bearing in mind we were risking around 75 pips and we're up just shy of 200. So we're already up well over 2.5% here. We're happy with the profits we've made. Let's lock in what we've made, because this overall is a sideways marketplace with the right hand side of the screen being an upward trend. Now, seeing that it's got to this resistance level up here, it could be a point whereby we see a reaction to the downside. It's worthwhile moving our stop loss to actually lock in as much profit as possible there. As it happens, price is breaking straight through the level, so we're happy with this. We'll keep hold of the position. And we actually then get a huge, great pin bar form up there. And that'd be a really good idea now to move the stop loss underneath that bearish pin bar and just lock in the additional profit. As it turns out, it seems to have been the right call. We can see this one here stopped us out, and the market seems to be falling to the downside now. And from 75 pips of risk there to make 275 pips of return. We actually got ourselves to a position where it's almost a 4% gain. It's certainly about 3.7% gain again. So another 3.7, 3.75 return. So over these two trades here, we've actually managed to have two winning trades that have actually netted us over 5%. So we can see again how this positive reward to risk and waiting for price action to give us the signals is a very good way to trade. Now we know that we had a resistance level here that is in fact right now being retested as support. Now as it happens, we haven't really got a price action entry yet. We've got ourselves a doji candle, a seller candle. We actually got ourselves there a bearish pin bar. Well, of course we're not going to take that, bearing in mind that we're looking to be long. Still no real signal yet. Here we go. We've now got ourselves a bullish pin bar. So we can look at this opportunity here as a potential entry point into the market. We'll have our entry point above the high of the bullish candle, and our stop loss can go there. Now, in this example, I'd actually put the stop loss underneath the swing low down here just to keep it safe. It's going to cost us an extra 5 pips to do this, but I'd rather have a 5 pip bigger stop loss to actually keep me a little bit safer, bearing in mind that price could spike down beneath that pin bar, not quite break the swing low, and actually end up giving us a losing trade. So let's put it underneath the swing low just to play it safe there. We've still got these higher highs and higher lows through here. As it happens, the bullish pin bar hasn't been triggered, so we wouldn't have been triggered into that trade. And we can see price has actually done another great big high test pin bar, another high test pin bar, been thrown back down to the downside. So actually we're looking for an entry now, still to the upside, because the cyclicity is definitely in our favour still, with these higher highs and these higher lows. We're looking for a reason to actually buy the market. This seems to be it. We've got ourselves a bullish pin bar there, identified again, not too far. Got a nice bullish pin bar, which I'll just mark on with an arrow. And it also nicely completes this reversal bar formation. From sellers into buyers, reversal bar formation. And again, we actually have a support level here because we have these resistance levels. Resistance, resistance, becoming support. I'll just mark that on the screen. You can see these resistance levels that get retested as support. We have horizontal level, price action, multiple price action signals, and bouncing off of the 50 moving average. This is a nice strong signal to want to enter the marketplace on. We'll pop our entry point there with our stop loss underneath the pin bar. We're happy with our entry orders on that particular pin bar there. We've been triggered into the trade. It's another bullish pin bar, which is good. We've got ourselves a bit of doji there, not a lot happening. Not a doji, not a huge amount happening there. We could be wrong because what could be happening here if you've got the a potential lower high forming, we could take a loser. But we're still in an upward trend. Cyclicity is still in our favour. So we're still happy that we're in this marketplace. We're heavily on side now. Odds are you'd probably be looking to move your stop loss to break even because price will probably get to around this level, which is at the horizontal level here, before it starts to slow down. We're happy that we've already reached that level, so we'll be looking for price action signals to exit soon. So it wouldn't hurt us to actually put our stop loss to break even. We'll leave it where it is for now, but we'll look at what happens on the next price action signal. Price is still going up, still going up. And it's actually around here we've now got ourselves a reversal bar formation, which could play as a potential exit. So what we'll do is we'll actually mark and move our stop loss underneath there, because bearing in mind that we've got ourselves a 100 pip stop, We're 1.6% up, we were 160 pips up, locked in there. It's a nice position to be in. We're still just in the trade. Bearing in mind, we give ourselves a few pips graced underneath the lows of the bars, so we're happy we're still in the trade here. And it seems to be the market's going quite sideways. Actually seems to be a strong move up, followed by a sideways move here. A couple of dojis through here. And bearing in mind we're still in this trade, there's no real seller signals yet. Our stop loss is still holding this level up to this point, which is of course now where the present day is. So what we do with this trade is we continue to manage it. Obviously, we've managed to lock in 1.6% guaranteed, but we're also in a position whereby the trade is currently running at a 3.6% gain. So we'd stay in the trade, and we'd actually now wait to see if there's a potential price action signal that could help us to exit in the coming days. We're happy that we've locked in 1.6%, and because we've only locked in the 1.6, I'll only record it as being a 1.6, but of course we know we're actually about 3.6% up on the trade at present. Now, having worked through all those different examples, obviously this is taken over a period of time, but I want to just work out what we've actually made on this particular market over the downward trends and the upward trends, and just look at what we've actually made from them. Now, in order to do that, we're going to take the percentages that we've actually made and lost through here, and we're just going to record them in an Excel spreadsheet. So the 1.9% gain to begin with, followed by 0.5% gain, then we lost one over here, then we had a 1.75% gain. As we progressed through there, a 3.7% gain, followed by a loser. Keep going through. This one we risked 0.5% here, so it's a 0.35% gain. We then lost 2. Back to back, that was annoying. As we progressed through, we then had a 1.5% win and a 3.7% win. Those both helped that very nicely. And we keep going through. We see that the trade that's currently running has locked in another 1.6%. Now, bearing in mind that's 12 trades on this euro-dollar currency pair over a year. Now, 12 trades over, what was it, a year? Let's have a quick look. January. So it wasn't quite a year. Roughly speaking, looking at this, it was about 9 or 10 months. But of course, we couldn't trade too much through here because the market was moving sideways. Now, if we just also sum it and work out percentage-wise, we can see that we're actually 11% up for the year on this particular currency pair. And 11% is a damn sight better than you're going to get in the bank in most countries. Now, with 11% on one currency pair, you're thinking 11% a year, that's not really that interesting. However, when we start to trade over 10 currency pairs, or even up to perhaps 15 currency pairs, we can see how these numbers start to get considerably bigger. If we can do 11% a year off of one currency pair, obviously we can do around that on each and every one. Obviously, the more currency pairs that we're trading, the more potential opportunities available to us. But you can see through here that we've generated a profit of 11%. Now, more than that, we're going to start to just look at the success rates as well. As it happens through here, out of the 12 trades, we won 8 of them. So we won 8 trades out of the 12. We can see we actually had ourselves a 66% success rate. So a 66% success rate is a pretty good success rate, bearing in mind that we've got bigger winners than losers as well. And beyond that, we can also see we can work out our average winning trade. So our average winning trade was, we add these together. What we're doing is adding the winners together now to work out our average winning percentage. 1, 2, 3, 4, 5, 6, 7, 8. we can take all of these, and we can see our average winning trade here was actually 1.87%. So we've got ourselves a 1.87% return on our trades. Our average losers here were 1%. We can see we had 4 losing trades at 1%. And we can see our success rate is 66%. Now, taking a 66% success rate, and of course taking 1.87% reward to risk, we can see that over a sample of trades, as in the results here, we expect to be profitable. And that's how your price action, your moving averages, and also your horizontal levels of support and resistance come into play with each other and actually help you to find high probability entries into the marketplace. One final thing to do now is actually create an equity curve of this, so we can see what the equity curve would look like on this particular set of results. So all we're going to do is we're going to just create a cumulative column here of the results, and we're actually then going to just simply create ourselves a chart of that. And this is now giving us our equity curve for what happened on the account. So this is obviously over a year-long period, but we can see that actually taking the trades from trade 1 through to trade 12 there, from trade 1 being obviously 0, from trade 2 to trade 13, 12 trades over the year, we can see that we ended up in profit of 11%, and we can see the equity curve there moved in our favour, against us, up again, against us, and up again. It's important to note here that no equity curve is going to go straight up. There's going to be periods of time where you take a few losers. It's annoying, but it's a case of, okay, let's look for the next trading opportunity. Now, we can see that this equity curve is actually moving in the right direction, and if we had obviously more results off more currency pairs, we'd expect this equity curve to go much higher than 11% for the year. But if we can do a 66% success rate and a 1.8% reward to risk, we can tell very simply that over a sample of trades, we expect to be profitable. The biggest point here is really to make you aware of is that it's having the bigger winners than losers that's actually helped us to be profitable, and very profitable. If we go back through and look at only perhaps taking 1% from our winners rather than allowing them to run, we take this here now, rather than having this 1.9, which would make every single trade a 1-to-1, we'd have actually won this one at 1-to-1. 0.5% there would have probably won. We'd have won, 1, 1, 1, 1, 1. Suddenly, our 11% gain is actually only a 4% gain. We've gone from being very profitable to being still slightly profitable. But I'd rather make 11% a year than 4% a year per currency pair. Because obviously times 10 or 15 currency pairs, that's a big difference. And we can see there for ourselves just how smoother it is by allowing these bigger winners. These big winners are what actually make the account grow. The success rate keeps us happy and psychologically able to keep trading. It's that reward to risk that keeps moving the account to the upside in our favour. Now that you've had the chance to see me work through these different examples on this euro-dollar chart, move on to the next video where I go through a different currency pair, but also take some time to look at the charts for yourselves and identify these high probability price action signals alongside the moving averages, the horizontals, and of course the cyclicity. Please make sure that you take the time to do this. You can't just learn from watching the video, you need to make sure you actually put it into practice. Of course, you've got the trading simulator available to you as well. This is a great learning tool that you can use with an example such as this, whereby you can actually play back the previous data and demo trade the data, and you can actually build an equity curve just from that.